would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name is Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to it once again, folks. Today is Thursday, and we're charging right through the week. Hopefully you are getting everything done you were hoping to get done this week. We've got an update on a story I shared with you a while back, and I think it's relatively good news. Some folks might disagree with me, but it's an interesting turn of events. I didn't think it would go this way, but we'll cover that real quick. And then we've got some other amazing news relating to where we are psychologically in the real estate market right now, where we are clearly and undoubtedly at, something we alluded to on this show as coming about a month ago, and it seems pretty clearly to be here. A couple of little tidbits to round out the show. Should be some good info for you to bounce around in your head, see what kind of effect it might have on your real estate choices, no matter what they might be. Before we jump into that, though, let me remind everyone that this Friday, 5 p.m. Pacific, tomorrow on the 14th, we're going to be doing the monthly drawing for a $50 Amazon gift card. And for those of you who would like to be entered into the drawing, simply go to therebelbroker.com, go to the top of the page, click the big red button that says Take the Survey to Support the Show. Provide the same email address both times you're asked, answer a handful of demographic questions, and you are all done. You're going to achieve two wonderful things by doing that. One, you're going to help the show grow. You'll be supporting me in my goal of growing this show. And you will also be getting your name into that drawing for the $50 Amazon gift card. Now, good luck to those of you who have yet to enter. Please do. I want to make sure I've got a nice big pool of folks to draw from for the drawing on Friday. And congratulations to all the folks who have won, I think, something in the neighborhood of $500 so far. So good luck. All right. I don't think there's any other housekeeping other than letting you know how to join the Rebel Underground. If you want to text the word Rebel Broker to the number 44222, that's the word Rebel Broker, all one word, to the number 44222. You'll get a response so that you know it's from me. Reply with the information requested, and you're in. It's done. If you'd rather do it online, again, you can go to therebelbroker.com, and in the show notes for just about any show, click on the red button that says Join the Rebel Underground, and you're in. You're not going to get spam. You're not going to get tons of emails, but you will get exclusive content only available to Rebel Underground members. So make sure to take advantage of that while you're at the site. All right. So this one is a little bit local in terms of state interest. This is a California thing, but it was something we talked about. I don't know how long ago it was when this first came up. It has to be at least a month, maybe 2 months now, where California was presenting the Healthy California Act, SB 562, I think is what it was called. And it was basically single-payer healthcare on the state level. And, no matter what your beliefs are relating to healthcare and how involved the government should be in your healthcare, this is kind of the way I think it makes sense to do it. If a state decides to do it, fantastic. Let's see how it goes. My tendency is, having read history and having lived under a socialized medicine system when I lived in England, it will crash and burn, and that'll be a terrible thing. But at least the lesson gets learned, right? We do the experiment in California, whatever state does it, and then it gets tried out for some period of time, and people can come to a conclusion on what works, what doesn't work. Just wanted to let you all know, because I promised I'd give you updates, that the Democratic Assembly Speaker blocked the proposal for universal health care and has been taking a lot of heat for it. But I'm actually surprised. We have seen such crazy stuff come out of Sacramento and California in terms of legislation. My feeling was this would go right through the normal political process and end up on the governor's desk, and it would take the governor not signing it for it or vetoing it or doing whatever the governor does to not support it moving forward and endorsing it to become law. And that's not what happened. It happened much earlier in the process. And on a weird level, that kind of restores my faith a little bit, because remember what we talked about. In order for this to get covered, you'd have to have the equivalent of a 15% increase in your payroll taxes. And I don't mean I mean another entire 15%. So right now in California, payroll taxes are what? 15.1, 15.3%. So it doesn't mean a 15% increase on that, which would just be 15% of that 15%. That means doubling it. That means doubling the payroll tax. And that means that for every dollar you earn, you take 15 cents less home in California. And all of you have read the headlines. It is very expensive to live in California. Housing is expensive. Gasoline is expensive. I have a friend who lives in Texas who just texted me a sign of the gas station he was at where he was paying $1.75 for a gallon of gas. And I texted him right back with my text, a photo of pumping up at the gas station for $4 a gallon for gasoline. So more than twice as expensive in California. And that's because of all the additives that, again, the folks in Sacramento have voted are absolutely necessary to be in our gas, and also extra taxes. The vast majority of how we pay for our gasoline, or what we pay for our gasoline in California, is taxes. If you eliminated all the taxes, we'd be paying just about what Texas is paying. But in any event, I wanted to share that with everyone because it was a huge deal. And the reason why I thought it was even worth mentioning was I actually had folks call me to do market analysis on their properties, because if this passed, they were out. They were going to move. They were going to sell their property and move. Some of them may still, who knows, but it wouldn't surprise me if this rears its head again at some point. It seems like quite a popular thing for folks who don't actually want to do the math on how much this stuff costs. But we'll see. And of course, I'll keep an eye on it. And if anything changes, I'll give you an update. I've got two other larger things to talk about. And one of them is, again, a little bit local, but it really speaks to the psychology of what's going on with buyers out there. One term that I have tried to, well, maybe that's not the right way to phrase it. Maybe the right way to phrase it is the one situation I have really been hoping we would not see, and I mentioned this in a show a couple of days ago, is being forced to describe buyers as in a frenzy to buy, right? Because just as things started to build up to those final periods where things went absolutely crazy just before the downturn, was this ridiculous frenzy of people buying sight unseen, bidding properties way up over their asking price. It was absolutely crazy. And so far this year, or for the first part of this year, my estimations of what was going to happen with the market have been relatively correct. I was expecting relatively flat, not a whole lot of craziness. But with the most recent data I'm seeing, that's proving to be less and less the case. We are no longer in this position where buyers seemed to be opting out of going nuts. And maybe it's because we've been sustaining this low inventory situation for so long. Maybe folks have just finally lost patience with the process and have decided, whatever it is, we need to get past this. Whatever it is, whether it's because there's low inventory, I don't care. I need a house. I want a place to live. I need a place that's mine. Whatever the motivations are, everyone's motivations are different. But the end result is buyers seem to have migrated into a place where, unfortunately, using the word frenzy is totally applicable. We talked about this the other day in terms of seeing, just in general, talking about purchases that were above asking price, just the frequency of it. Well, now we've also taken the next steps to the next level of crazy. And that is, not only are we seeing way more folks sight unseen overbidding or bidding way over asking price, it has now gotten to the point where tons of homes are going for hundreds of thousands of dollars over listing price. And this is relatively a relatively new event. This is something where if you look at the data for about the last month or so has been the case, particularly in communities like Cupertino and Sunnyvale, which are areas we've talked about before as sort of being at the heart of Silicon Valley. Cupertino is where Apple is located. Sunnyvale is where there's a ton of high-tech companies, lots and lots of different high-tech companies. A lot of folks would argue that Sunnyvale was actually the birthplace of Silicon Valley. So that's kind of right there at the heart, but I'm also seeing this being a more broad thing. While we can tell some very amazing stories about what's going on in Cupertino and Sunnyvale, there are also other areas outside of Cupertino and Sunnyvale that are less dramatic in terms of the numbers, but show the same trend. So that's what's got me worried, and I'm interested in finding out how widespread this is. Now, I have a pretty good handle on what's happening here in Silicon Valley. I'd love to get an idea of what's happening in other markets like Los Angeles, Phoenix. Denver is also pretty crazy from what I'm hearing from some folks who reach out to me who listen to the show. I'd love to get a better idea because for a while there it was sounding like things were really starting to mellow a little bit, and that seems to be done. When you hear how much done it is, it may blow your mind. So we're going to go ahead and take a quick break here, but when we come back, we're going to get into some real-world numbers that really demonstrate that we have gotten into that feeding frenzy in real estate. And the thing we'll talk about why it scares me so much. I'm sure most of you who've listened for a while realize why this is a scary new milestone for our market. But we'll discuss that a little bit more right after this.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. We've sort of crossed a threshold, I guess. We mark the real estate business in a lot of different ways. Once interest rates get above or below a certain point, once prices sort of hit a certain point, or once the inventory numbers hit a certain high or a certain low. There's all these things that we sort of put out there as milestones, things that we should take as indicators of what's going on with the market, whether that's how many months of inventory we have on hand or how rapidly homes are selling, all those, or how much more a home is selling for this year at the same time last year. But one of the biggest things to understand, primarily because it's also a leading indicator of bigger problems, and those problems being the ones that feed the kind of market that scares most of us, or should scare most of us, where prices just start to go insane. All right, so let's get down to the nitty-gritty and talk about some specific numbers here, because it is kind of shocking, and it's on par with the worst of the craziness that we saw last time. In Cupertino and Sunnyvale, there were dozens of homes sold for at least $200,000 over the listing price in the last 30 days. That's the subheadline of this article coming from the Mercury News, which I will link to in the description of the show. So make sure to check that out if you want to read the whole article. Now, in the article I'm referring to, it does make reference to the idea that things had looked like they'd sort of calmed down a bit in the Bay Area market. But with these latest numbers, it's absolutely nuts. There was one specific home listed for $999,000 and sold last month for $1,210,000, $211,000 above the asking price. Dozens of homes in Sunnyvale and Cupertino did the same in terms of being over $200,000 above asking price. And what's amazing is this was not a giant home. I mean, these are not mansions we're talking about. One good example is, let's see, We're talking about one Cupertino house that's 1,046 square feet, sold for $660,000 above its listing price. So that's not what it's sold for. It's sold for $660,000 above its list price, which probably brought it up to somewhere in the neighborhood of 1.6 million, 1.5 million. A house on Heatherstone Avenue in Sunnyvale listed at $1,888,000 and sold for $2,370,000, $482,000 over asking. A house on Croydon Court in Sunnyvale listed for $1,998,000 and went for $2,450,000, $462,000 over asking. A townhouse, not even a single-family residential home, on La Mesa Terrace in Sunnyvale, listed for $1,099,000 and sold for $1.4 million, $301,000 over asking for a townhouse. Now, here's what's shocking to me, and why maybe for someone like me, this kind of gets the butterflies going and makes me a little nervous, is this is the crazy crap we were seeing just before the downturn. The year and a half before the downturn, this is what we were seeing. This frenzied buying it sight unseen, offering hundreds of thousands of dollars over asking price. And what it did is it just accelerated how fast property, I hate to even use the word value, but the amount properties were selling for, because there wasn't any actual value there. Back then, it was because of competition. There were just so many buyers being created that it created this bizarre situation. Now we're doing the same thing again, but in an environment where there's artificially low inventory. And I guess maybe saying artificial is unfair. The inventory is low. I refer to it sort of as artificially low simply because what's keeping it low is a whole lot of expensive regulations that are making it difficult for builders to build and to build in a way where they can even build mainstream properties. If they want to build a home, they have to build things at the high end simply to be able to cover all the expenses involved of developing homes. Let's see. In Sunnyvale in 2016, 75 houses, condos, and townhomes sold during the 30-day period. Of those, 58 sold for more than the listing price, but only 8 went for $200,000 or more above asking. This year's 30-day totals for the exact same period of time, 84 homes sold, 74 for above asking, including 37 for $200,000 or more above asking price. Now, in Sunnyvale, those 2016 numbers, 60 homes sold, 45 above asking, 5 selling for $200,000 or more above the listing price. This year, 60 homes sold, so the same number. 50 were above asking, including 15 that were at least $200,000 more than the listing price. And that's the bar, right? That 15 number isn't 50 of the 60 were above asking price, but 15 of those were $200,000 or more above. I used to live in that area. I used to live in West San Jose, right next to Cupertino. Cupertino was literally across the street from the street where I lived. I'm very familiar with that area. I know a lot of these streets and addresses, and some of these are not the newest homes. A lot of these are not homes you would expect to pay that kind of money for. If you saw these homes anywhere else, you wouldn't be expecting to pay more than $180,000, $200,000 for these properties, and they're going for multiple millions of dollars. Let's see. Way over asking sales in Cupertino include a house at Raelia Court that listed for $1,299,999, so $1,299,999. I hate list prices like that. And sold for $1,622,500, $322,501 over asking. Another home on North Portal Avenue listed for $1,788,000, then sold for $2,160,000 with 11 offers, all cash. A cool $371,200 above asking price. I'm sharing this because this is nuts. We are full on, at least from the standards of the Bay Area, where I have been since 1988, where I lived through the downturn last time, where I lived through the build up to the downturn. This is leading up to the downturn territory for last time. Does that absolutely equal a downturn this time? Not necessarily, but given everything else we've talked about, given all the other elements that are in play, it's hard to come to a conclusion other than we have set the stage exactly as it was set before. And now the mentality or the psychology of the buyers out there has reached this crazy frenzied point where no one seems to be thinking about the sustainability of a price or whether or not this makes any sense or how much debt they're willing to take on or whether or not there could be a downturn that it could affect their ability to earn. These are all scary things. And frankly, I think it makes my decision to sell my home sooner rather than later and then hold on to my cash and wait for a downturn. In my eyes, that's a gamble I think makes a lot of sense. Now, when you blend all that with what we talked about yesterday in terms of the stock market as a good example, where 15 to 20% drop, and we kind of extrapolated, well, what then happens to pensions? There's a link I'm going to provide in the show notes from the Mercatus Center, George Mason University, that has basically released data on ranking the states by fiscal condition in 2017. And there's lots of data here that you can push through, a lot of interesting things that you can look at in terms of how well states are doing. The top 5, I'll just rattle them off here. Florida, North Dakota, South Dakota, Utah, and Wyoming are the top 5. The bottom 5 are Maryland, Kentucky, Massachusetts, Illinois, and New Jersey. So financially, these guys are ranking New Jersey as in bigger trouble than Illinois. And Illinois, as we all know, now has pension obligations that make it so that there's no money to spend after they spend the taxes that are taking it. There's zero money left. Everything they bring in goes to pensions. And if you sort of look through this and sort of look at what's going on, each state in the bottom 5, each state have massive debt obligations. Each of the bottom 5 states exhibit serious signs of fiscal distress. Unfunded liabilities continue to be a problem, specifically mentioning unfunded pensions. And this is a big deal. This isn't limited to Illinois. There are all kinds of states that are having this problem. And to show you how big the crater is on this. Now, remember, we've talked about, people can talk about Illinois, right, in Chicago and say, well, just Chicago, Illinois has problems, right? Well, we're seeing these problems in states that don't have problems in terms of, or that shouldn't be having problems. States with growth, states with lots of companies moving in, states that are seeing lots of new people moving in and broadening the tax base. So despite the fact that tax collection should be at these all-time highs, and are in many cases, these folks are still overwhelmed by pension obligations. And an article came out from the Los Angeles Times, quote, for the title of the article, "A city pension board vote could add to Los Angeles budget woes." So even in places where we've been seeing areas that are considered in great recovery and things are going really well, like Dallas and like Los Angeles, these kinds of problems are still there. Now, what's interesting about this is the meeting that's coming up, according to this article, quote, "The board that oversees the Los Angeles City Employees Retirement System will meet Tuesday to consider cutting its assumed rate of return." This is how much they assume their investments in the stock market will make them, right? The yearly expected earnings for its investment portfolio from 7.5 to 7.25%. So this is the minimum that they plan on, and odds are they're wrong. Most of these guys who do this pension stuff expect way too much out of the marketplace. The move that they're doing here is expected to shift about $38 million in retirement costs onto the city's general fund, which pays for police patrols, firefighter staffing, and other basic services in mid-2018. The pension board also has the option to pursue a more dramatic step, taking the investment assumption 7%, which would add $93 million to the city's yearly pension burden. So that's the assumptions they're making. I wouldn't make that assumption. I actually think that we'll see not that level of growth. I think we could see pretty creepy stuff. But this is, just keep that in mind, right? When people talk about potentially overstating the danger of the pension situation and say, well, it's just Illinois or it's just Dallas. It's not. It's a whole bunch of different states. California is right there in the mix. And what's creepy is a big decline of 15 to 20% in the stock market equals really bad things for these guys because they won't make that 7%, which is already too high. They're expecting more than 7%, but they'll get less than that. And so they'll end up with these huge deficits that they're going to have to deal with. And if you don't think that's going to spread like wildfire into other elements of the economy, you didn't pay attention last time. So keep an eye on this. Of course, I'll be keeping an eye on it for you. We'll see what happens as this expands. But, you don't even need to focus just on Los Angeles and Illinois. You just go ahead and do cities facing pension problems on Google, and you will have plenty to choose from. It's absolutely ridiculous. Okay. In other interesting little tidbits, stuff that should also scare you, because remember, there are certain groups of folks out there who are extremely careful about what they say and how they say it. And nobody embodies this more than Janet Yellen, the head of the Fed. Because when she says things, people wet themselves if it's not the right thing. It can cause huge amounts of uncertainty in the economy. And as we've talked about on this show before, one of the worst things to happen to an economy is a ton of uncertainty. People really hold back their funds. And you know what's really funny is we've been in this constant state of uncertainty. That's why so many of these corporations are accumulating billions and billions of dollars, because they have a high level of uncertainty. They want operating capital to move forward. When companies are super confident about stuff, they tend to spend a lot more, grow more, invest in infrastructure, do all these other things. But we haven't really seen that. Like Apple, Google, all these companies that are just amassing billions and billions of dollars, that says to me, these are companies that feel uncertain potentially about what's around the corner. So when Janet Yellen says something, Janet Yellen doesn't ever go out, get drunk, and say something funny that could then set the world on fire financially. This is somebody whose every word is pondered long before the words come out of her mouth, particularly when she is in front of like organized groups, right? Let's see. Fed Chair Janet Yellen surprised markets again when, after weeks of hawkish setup, remember they've been talking about how wonderful things are and how many increases to the prime lending rate there were going to be. She suggested that the Fed is not only uncertain about when and how much inflation will respond to tightening resource utilization, but warning that the federal funds rate may not have to rise all that much further to get to a neutral policy stance. That is definitely a step back from what she's been saying over the past year. Goldman Sachs was surprised by the comment, and they were quoted as saying, "We read the paragraph about the neutral rate as slightly dovish for the longer run outlook, particularly the comment. The federal funds rate would not have to rise all that much further to get to a neutral policy stance." Chair Yellen confirmed that she still expects the neutral rate to rise somewhat over time, but remain below levels that prevailed in previous decades. So that's kind of creepy. It shows a softening in terms of what the Fed is expecting. And the Fed Chair Janet Yellen warns Congress, in another comment, warns that U.S. debt trajectory is unsustainable. Now remember, this is what she's saying to Congress. This is the kind of thing where you take an oath and then get asked questions and say things. And she's telling Congress that the debt trajectory for the United States is unsustainable. Now, that's not wrong. I agree with that. But someone in her position to come out and say that causes a lot of people to come close to passing out. During her testimony on the 12th, on Wednesday, Fed Chair Janet Yellen urged Congress to take into account the growth trajectory of the federal debt when making decisions about spending and taxation. She said lawmakers need to work toward achieving sustainability of this debt path over time. Quote, "Let me state in the strongest possible terms that I agree. The U.S. federal debt trend is unsustainable, may hurt productivity and living standards of Americans." So two hits there. Within 20, like right at the same time, that really undermine things she has said previously or actions that she was implying the Fed was going to take in terms of growing the prime rate. So there you go. Lots of interesting things have happened since the last time we talked, or at least a lot of new subjects have come up that really reinforce this idea that we all need to come up with our plan. How are we going to react as real estate buyers, sellers, and investors in this new dynamic where where it's looking like, at least to some degree, bad things are ahead? So I actually had one listener reach out and go, well, then why don't you just keep all your money? Why not take it out of everything and just hold it? Well, and primarily the reason is that's not a neutral stance, right? People think that by holding cash, you are taking the safe route. Well, you're not. Because inflation will always screw you over. You will lose. Maybe it'll be the least amount you lose, right? Remember, we talked about accounts last year when things were really nuts, where some places were having you put money into an account with negative interest rates, where they charged you to keep the money there. Just holding on to cash, just stuffing it into your mattress may keep that physical chunk of money in your possession, but it still is negatively affected by inflation. So you need to go with things that in some way will hedge you against inflation, but not only inflation is always there, right? So that's something we need to calculate as investors and owners and sellers all the time. But we now need to take that into account under the added pressure of a potentially challenging economy for real estate in the coming couple of years. So what do you do? Well, I don't think you necessarily get rid of all your real estate. You absolutely reevaluate. You take a look at your current holdings, figure out how much headroom you have in terms of how much it costs you to maintain the property versus how much you rent, how much cash flow do you get on these properties. And it may be an opportunity for you to sit back and realize, you know what, maybe I need to get rid of some of these lower performing properties and move into markets where I can get better performance out of my money. But I think in a time when things are going to get tough, you go to fundamentals, right? You go to the things that are really at the core of everyday life. So we're talking food, we're talking housing, we're talking, potentially transportation, but core things, right? The most fundamental things. If you link your strategies to things folks absolutely cannot live without, you're going to be as protected as possible. So even though we talked about yesterday, real estate potentially losing its value by 50 to 75%. That's just if you sell it, right? If you buy a home for $100,000 today and its value drops to $50,000 tomorrow, you don't lose $50,000, right? No one comes and takes $50,000 away from you. You only lose if you sell the home under those circumstances. However, as an investor, it would still remain a performing asset. In other words, it would still be generating income. If we see the same trends we saw during the last downturn, and we may see a different dynamic play in this time around, simply because, again, we are at a lower point to potentially start from. But if we do see a downturn, and if it goes the same as last time, rents really didn't go down. My investors in Silicon Valley did not have to lower their rents. I think a few, in deference to their renters, because they really liked their tenants, didn't raise rents for a year or two. But that was it. That was their worst case scenario, a pause in increasing rents for a year or two. I think I would build in some sort of buffer or have a buffer so that if needed, I could lower my rent a little bit and be super aggressive if that was necessary. But remember, I think in most of those situations, these would be folks who would see the market potentially flooded with new renters because of folks having to move out of their homes, but would also potentially see that finances have gotten so bad that folks that are currently renting a single-family residential home move into an apartment to cut the monthly costs. And I think those are really the two dynamics that are in play that still equal single-family residential properties being desirable rentals, right? Because you'd be getting exit pressure from folks maybe who are looking to reduce their costs, but you'd get entry pressure from folks who are potentially losing their single-family residential home. It really just depends if those two things happen at the same time. If they don't, if there's distance between the two, there might be a period of lower demand, right? And again, I'm saying these in terms of trying to come up with strategies that would apply nationally that you can use in your life, because honestly, in my market, I don't see that happening. We simply don't have enough rentals, period. Whether you're talking about single-family residentials or apartments, there's just not enough. The volume is just way too low. So I think in a market like this, if you own a single-family residential home, your rents are at the very worst going to potentially stay the same for a year or two. But that would be an outlier. I actually think that probably you'd still be in a position where rents are pretty robust moving forward. Okay, so I hope this has been good information for all of you. The goal is always to leave more on the table for you to take with you than you put on the table in terms of time invested to listen to the show, and I hope we've delivered on that today. Thanks again for listening, everybody. I'll talk to y'all next time.